I'm so excited to have the pleasure of having Mish Schneider and Helene Meisler here with us. Hello, ladies, and happy Sunday to you.
Hi.
Hello.
Thanks for having me.
All right, I got you both, and we have you here. Hold on, really quick. I need to let me go ahead and tweet something out, because I've been stuck literally in the seat for the last few hours, and I have not been able to attend to social media. Join in discussion.
Hope you haven't had a lot to drink too.
I have not. I've been periodically turning my camera off so I can guzzle some water, but it's all good. I've had like 14 cups of coffee this morning, and it's still 9 o'clock in the morning here, so that's good. So anyway, ladies, so nice to have you both here. Now let me give you, for people that don't know, for some reason, if you don't know who these ladies are, you should. So Michele, or Mish Schneider, this is really I've known this about you since reading your book, but also meeting you. Mish is one of the first female floor traders on the New York commodities exchanges in the World Trade Center. She's the director of trading education at marketgauge.com. So Mish, so nice to have you here. You know, it's you speak on a lot of the news outlets, whether it's CNBC, Bloomberg, you know, Fox News. It's always a pleasure to have time with you. And Helene is she's a contributor at Real Money Pro. Is that correct? Is it Real Money Pro?
Real Money, not Real Money.
Real Money. I don't know.
I'm not a pro. That's the problem.
You are a pro. Helene, I'll tell you, she's one of my favorite technicians to follow. There's very few people that I've met in my career that, like me, you know, we've printed out charts on paper. You know, you plot your trend lines, and you use your fib levels, and you see your resistance and support. Very few people that have done that as it is. There's very few people that do it in real time now, and those are charts. I was wondering if that was like that was art or actually charts, but I guess you could argue it's both.
Two charts. You probably can't see them. The top one, and I've hung it terribly because it's a little cattywampus, is Tilray, and you can see what a lovely stock it's been, because I've had to add 1, 2, 3, 4. It's fallen off the bottom of the page 4 times. And the bottom one is Peloton, which has fallen off 1, 2, 3, 4 times as well.
Oh, post-COVID demolition stocks, I'll tell you. Well, Helene, it's also such a pleasure to have you here. And the reason why I invited, sorry guys, I'm not gonna give credit to anybody else on the team but me. The reasons why I wanted to bring the both of you two ladies on here, not only are you two both very beautiful people, but it's your knowledge that you have behind you, and the years you've been in the markets. And in times like this, when we are dealing with markets that most people have never ever experienced, you two have been in the markets for a long time, and I'd like to spend some time with the two of you, probably with different approaches, but ultimately, you know, the longevity that you both have had in the markets speaks volumes. And I think we as traders and the trading community can really learn and benefit from the knowledge that you have. So let me start off with Mish. And Mish, I know you have your eyes on pretty much every index out there, and you have your pulse on what's moving the markets. But let me ask you, what is it that you're seeing that is suggesting that a lot of people believe there's a low that's being formed in the market for the year? And let's just talk about, you know, 2022, even though we only have a couple months left. A lot of people think that there's a low being formed here, and it's a tradable low going into the end of the year. Do you see things that way? And is there anything out there that suggests the otherwise?
Okay, well, before I start, I just wanted to say hi, Helene, because I have been a follower of yours on Twitter. We've never actually met before, so it's such a pleasure to meet you. So thanks for Blake for putting us both together.
So happy.
Yeah. So there is definitely evidence right now that we could indeed have an end of year rally, or at least a rally. It's a bear market rally still until proven otherwise. I think the biggest evidence that we see from a technical standpoint right now, interestingly enough, would be the small caps, the Russell 2000. When we took that final dive a week ago, the Russell 2000 held the June lows, which I thought was significant. And I'm just speaking purely technicals here. We can always go later on after I hear Helene speak more into the fundamental case for both sides, bear market rally, not bear market rally, beginning of something or not. And the other really, really big evidence that I've seen technically is, besides the Russell 2000, if we're going to use IWM as the symbol, the other two really key sectors for the United States that I follow, which is my economic modern family, is the retail sector as measured through XRT, because it's a nice basket of all different types of retail, staples, discretionary, e-commerce, and of transportation that I like to look at through IYT. Obviously, that's going to be your freights and ships and airlines and how goods are moving and people are moving just in this country. So those are US centric areas that I watch. All of them held a 6 to 7 year low business cycle as measured by the 80-month moving average, which is something I like to look at on a longer term to kind of remind me of where we're at in a business cycle through the chart. And the fact that they all held is significant at this point for two reasons. One, the obvious reason, they held. So there's talk of deep, deep recession. Have we seen damage? Clearly. But in the real inside sectors, as Stanley Druckenmiller would call them, of the US economy, we've just held this major support. So that's the good evidence. Of course, the other interesting evidence is if that breaks, then I think we have a new ball game and possibly a much lower market. But for right now, with the seasonals and the way the charts look and the potential double bottom in IWM and the rally that we saw on Friday in the face of the yields rising, to me, and earnings doing a lot better with a lot of big ones coming up this week, it suggests to me that for now, it's probably okay to assume bear market rally.
Okay, and that's really great points you make, especially with the IWM. And I know you follow that the Russell 2000 very, very closely. That's like it's almost like a centerpiece for our conversations over the last, let's call it, year and a half, as you were signaling that we were going to turn lower as well. So that's interesting you point that out. Helene, I know you focus a lot on sentiment. Oh, wait, actually, I'm going to get back to that question. I do want to mention, ladies, you have the ability to show your screens if you want to show charts, or if there's something that you want to talk about, you have that ability. But just wanted to throw that out there just in case you do. But Helene, I'm going to go to this question about sentiment, and you look at a lot of sentiment, and it's something that you cue into all the time. And I'm going to say that we were having a discussion earlier about the conversations we've had with all of these experts in the industry over the last few days, and it seems like to me that everybody's bearish, and you can throw my name in that camp too. But are you seeing points to, or are you seeing the market as an extremely bearish sentiment, almost to a point where we might get a counter trend type of longer term bounce at these current levels?
Well, it's funny that you say that. 3 weeks ago, which actually I think I chatted with you about 3 weeks ago, and in the end of September, I think bearishness was at an extreme then. I think, as Mish has said, a lot of individual areas of the market have not collapsed. You know, IWM, to that I'd add mid caps, the transportations, as you said. And even if you want to go further than that, what about the industrials? I mean, they're at a higher low as well. So, I mean, housing, for all the nonsense about how bad housing is, the ITB can't break to a lower low than it was last spring. So there's a lot of holding going on underneath. And so I think 3 weeks ago was your extreme bearishness. And I think what's happened over the ensuing 3 weeks is we have actually picked up a few more bulls here and there, as opposed to everybody being so outright bearish. Now, I've got a few statistics I can show you, I can tell you about, like, for example, a few weeks ago, the Investors Intelligence bulls were down to 25 or 26%, and they're already up to 31%, and that was without last week. And last week, the S&P was up 200 points.
Yeah.
I can tell you that I like to look at the National Association of Active Investment Managers, their survey every week, and it's their exposure to the market. Well, several weeks ago, they were at 10 or 12, and now they're at 43. So no, I don't think bearishness is quite where it was 3 weeks ago. I think people have been, as I like to say, warming up to the market. The last statistic I'll give you is that Friday's equity put call ratio was 58. That's the lowest in a month. So my column coming out on Monday is actually, I wrote all about, this feels a little bit more like the Tug McGraw, you gotta believe market. I really feel like everybody is starting to think, you gotta believe, we always get a low around the midterms. You always get the year-end rally. So is the low in for the year? I have no idea, but I started to see all these things take place 3 weeks ago. So I'm not terribly surprised that, as I like to, I think I use this with you, Blake, is that I always view bulls and bears as neighbors sitting next to each other with a fence between them. And 3 weeks ago, the bears were in their lounge chairs, having margaritas, fat and happy. It was actually even Fat Bear Week, if you might recall. And I think what's happened is they have slowly gotten up from their chairs and moved towards the fence. And I fully expect, based upon those statistics I just told you, if the rally continues, you're going to see hopping the fence fast. And if the bonds, which I can get into that in a minute, but if the bonds stop going down and actually, oh my God, heaven forbid, rally, I think they're going to jump that fence faster than you can imagine. And I think you're going to see sentiment shift really fast.
Well, let's talk about the bond market really quick, and thank you for that, Helene. We've seen this, just the bond market is thrown off every 60-40 portfolio split that's been in existence for the last 30 years. It's thrown those off quite a bit. We have this just demolition of the bond market. Do you see any relief in sight?
Well, I can tell you what I saw on the end of last week, Thursday, Friday, was if you take a look at the volume in several of the bond ETFs, TLT was the highest volume since May. You look at MBB, was the highest volume in at least 5 years by almost 5 times. And there was another one that I'm forgetting now.
That's all right.
Was also the highest volume that we've seen in 5 years, and also by at least 3 times the volume. So there was some level of capitulation late last week. Does it continue? In terms of, will we now get a rally? We should. In addition, the daily sentiment indicator for bonds is now in single digits. It got there Thursday night and it stayed there again on Friday. So yes, the pieces are in place for the bonds to have some sort of a relief rally.
So, Mish, how do you see the bond market right now? And is it something that you follow? I'm sure everybody seems to be following it because it is obviously the thing that seems to be the driver at the moment. But how are you seeing the bond market currently?
Well, definitely I saw the capitulation and the high volume. And actually, I also wrote a daily, since you guys get it every day, about, are we getting to the point where the bonds are so oversold, or the TLTs are so oversold? But I want to step back a little bit. And one thing that was interesting was that while the TLTs took a dive, the junk bonds didn't exactly rally, but they actually were in the green on Friday, where the TLT still closed red. And so
HYG was too, Mish.
exactly. Same, Helene. Yeah. I mean, it's like kind of 6 of one, half a dozen of the other. Their charts almost look identical. People just I like junk just because it's so visual to me. I literally picture junk. But yeah, absolutely, Helene. It actually closed green, which means that bond traders came in ahead of even the market starting to rally. The indices were actually still red at this point. And they've been buying at these levels, these high yield, high debt companies. So I thought that was kind of interesting. In terms of the actual bond market in general, I have my theory on what's going to happen with the Federal Reserve here. And one is, I do not think they're going to pivot, but I do think that the rate of change and how fast they went up to these levels will slow. So that's different than pivoting. So if they slow, will that be perceived as a sigh of relief? Absolutely. And initially, and by the way, I'm so glad Helene mentioned industrials, because I think we're also heading into more of a macro theme of reindustrialization in the United States, but I'll put that on the shelf. Getting back to the bonds, the thing that we have to be really careful about is the bonds may be a very important indicator, but while the yields were going up and then started to relax, the long bond, actually the curve flipped the other way, because the long bond yields went higher while the short-term bond yields came lower. And then the dollar dropped, which everybody, of course, has been talking about how the dollar has been the kingpin of everything, the flight to safety, which tells me that with all of this roseate picture that we can potentially paint, that maybe the rate of change will slow or what have you, is this could also be another resurgence of inflation, just in different areas than what we saw post-pandemic. And that, I think, is still going to be my biggest concern, because the Fed and the perception of the Fed as not really being in control of this could actually turn out to be a really dangerous situation, ultimately for equities, ultimately for the dollar, but very, very bullish for some commodities, energy, precious metals, and things like that.
Thank you for that. And thanks for that macro backdrop, because I want to ask Helene this, because Helene, I know, you are like the queen of technicals. You really are. If like, I need to know what a chart is doing, I ask Helene. That's like where I go. It's like, that's where I'm going to defer to. So Helene,
what do they call King Charles's wife? Queen consort. Queen consort.
Queen consort. There you go.
But so that must make me your lady or duchess or something.
You're my macro maven. How about that?
Okay. I like as long as Helene and I are still in the royalty. When we women get to a certain point, we like being compared to royalty.
Both of you ladies are in my book, that's for sure.
But sometimes the alternative.
So Helene, where does like the macro backdrop fall into your game plan, your trading plan? Because I know your price matters to you. I understand that. And I know, you look at sentiment and there's other things that you do look at. Do you pay, how much emphasis do you put on what is happening, like from a macro standpoint, I guess is the question I wanted to ask.
I look at it a little differently. I'm not a Fed watcher. So I am never going to be the person who says, here's what I think the Fed is going to do, because the Fed does what the Fed does and shouldn't matter to me. I have likened for several months now, I've likened this market, although I'm not big on analogs, so let me say that up front, but I've likened this market to that first big leg we had down off the 2000 high. And then we had, and there isn't the equivalent now, but in 2001, we had 9/11 and the market was closed for 5 days. And when it reopened, it capitulated over a 5-day period and we rallied. But we went from that point forward, we stayed in the 10 or 12% trading range for months. We went up, we went down, we went up, we went down. And I've often said, when you look back, that was the market dealing with where are we in the cycle. And I think in bear markets, you tend to get a lot of that. You actually get it in bull markets too. And I think since last spring, we're in that period of We got the summer rally, then we came back down, and we're sort of now toying with the old lows. And so now we're sort of back into that trading range again. And I think we can have that for a few months while the market sorts out. Where are we in the inflation cycle? Where are we in a Fed hiking cycle? Where are we in the big picture? Now, in 2001, we stayed that way until the spring of 2002 when we fell out of the downside. I don't know that we're going to have that. My guess is we probably will. But right now, that's where I think we are. We're in that long period of time where the market is trying to figure out where we are in the cycle.
So that brings me to a question, because this is going back to the S&P. You're looking at this 10-year really sideways price action we saw after the dot-com bubble, and this is where your experience is going to matter for both of you ladies. And let's go to Mish really quick. You know, I've always been in the, like, my base case has been, you know, we've been in this massive bull market since the GFC, if you will, since the housing crisis, and all this liquidity has been thrown at the market. And so after we've partied for 13, 14 years, we're going to have a hell of a hangover. So we're going to have to kind of consume all of that. Do you feel the same way, or am I crazy? What are your thoughts here, Mish, based on in your experience, not only back then, but even previously?
Well, yes, absolutely. That I agree, by the way, about a trading range, but I'm going to go back a couple of decades, Helene, and go into the 70s because, yeah. So because I was just getting interested in the markets in the mid 70s, and I started trading in 1979. And there's very different, obviously, now than it was then, but there's also some striking parallels. So I don't think you're crazy at all. I mean, the biggest thing is that what put the kibosh, obviously, to the commodities market was Volcker. And we are in a very different situation now than we were back then. I mean, the Dow was trading at like 600 back then. And all of the commodities had taken a big flight, but it was all based on a few factors that we see right now. Number one is geopolitics. At that point, of course, it was the OPEC embargo, the oil embargo, that drove us into a recession in 74. Then we came out of that. You know, remember, we were just out of the gold standard at that point, and the Fed wasn't as big a factor at that point. They were just starting to become a factor. Two, in terms of the geopolitics, we had a war, Vietnam War. It was starting to end, but now we have more of a global type of war situation with the potentials floating around everywhere. And one thing that we have now, more so than I even remember back then, is we have a situation where, I'm not going to say climate change, but we have a very fragile climate in that we're seeing either extreme drought or we're seeing tremendous flooding, depending on what region, and a lot of it is impacting food. So we have a global food shortage in many, many countries, even though we're not feeling that impact here. And so this is why I think that what saved us after that in the 80s, once Reagan became president, you know, things started to calm down in terms of the interest rates. They peaked at like 20%. And then we started to have more growth. So right now you have to say, where is all this growth coming from? I'm not sure yet. I mean, obviously digital tech, but I think we're a little far from that to say, oh, that's what it's going to be. Can we get industrial growth? Well, the other thing we had was a very contentious political situation when Carter was president that turned to Reagan. And now we have another contentious presidential situation, in some ways even worse. So when I put that all together in my head, along with the charts, we had a stagnation happening in the markets there. We don't have low labor yet at this point. We could. In terms of the unemployment numbers, that's really a stagflation, is lower employment, higher inflation, and a trading range or a stagnation in economic growth. But certainly, to Helene's point, it's very capable of just staying in this trading range while all these other factors still weigh themselves out. Worst case is inflation goes out of control, more because of food shortages, hoarding, geopolitics, social uprising, continued weather not cooperating. And best case is we muddle through it and things start to improve. But it's going to take a long time. Let's look at the energy. You can't just decide to drill and all of a sudden, boom, there's going to be more oil. You know, a lot of the coal mines were shut down, so trying to get them back. And then, of course, the solar energy and the clean energy is a process. So these food, you don't just say, oh, I want more wheat. Oh, I want more corn. You know, these are all things that are going to take at least 2-3 years, I think, to work themselves out, which definitely supports a trading range, but potential also lower if we don't have a Federal Reserve like we had back then, one that is really, really more worried about its reputation and the destruction that it's caused in terms of the wealth, you know, 15 trillion or more being wiped out of the market in the bond market.
Yeah, that is, I mean, the numbers are absolutely staggering, especially if you think about the numbers that we used to deal with, even for me, you know, 20 some odd years ago, but to what, you know, we've dealt with in times past. Helene, what does this environment, do you have any environment back in your past years, you know, whether, you know, years ago, maybe even when you're at Goldman Sachs, that this market feels very similar to, would you say?
No. I would flip it upside down, and I would say that I think it was 2013 and maybe again in 2017, we had what I would call a relentless market, a market that refused to correct. It just kept going up. Every single dip was bought like in 3 seconds flat. And you had what I thought was an unnatural market, because I think corrections are healthy and I think, you know, shakeouts are good. And I feel like, with the exception of sort of the last few weeks, that move from the beginning of August or the middle of August until the end of September was absolutely relentless. And in that respect, it felt like the inverse of what we got in those years on the upside.
Yeah, it was this one right here, relentless selling, that we just recently witnessed, right?
Right. You know, I think the most we had 4 days of rallying in early September, and then that was it. You know, you'd get 1 or 2 days here. I mean, it was absolutely relentless on the downside. And so we'd get oversold and we'd relieve it with a 1-day rally. You know, back in, I think it was 2013 or 2017. I can't remember the exact year, because 14, 15, and 16, we definitely had ups and downs. You had, you know, you get a 2-day pullback and that would be it. And that felt as unnatural, quite frankly, as the selling that we've gotten in the last 2 months.
That was, by the way, Helene, that was 2017. It was probably the easiest year for the bulls that I can ever remember. Yeah, and I mean,
2013 had the taper tantrum, right?
Yeah,
right. There it is, right
yeah,
there.
that came at the end of 2018, but from 2017 up until that point, it was like everybody looked like a genius because the market was relentless. Yeah.
Right.
Speaking of geniuses, let's take. This is great, because I always get a kick out of this, because for me, I'll speak on in my experience, I was looking at the last couple of years going, we are just reliving the .com bubble, because I am seeing all of those same people that I was back in the 90s as a .com trader and a .com investor, as crypto investors were, you know, the last couple of years. And I mean, you get that excessiveness at these highs. And I mean, and everybody looks like a genius until they don't, right? So what do you have to say to those traders that have really entered the market? And I'm going to start off with you, Mish. Let's talk about like all of the traders that you've seen emerge since, let's just call the COVID lockdown, because there's a lot of them, right? There's a lot of
25, I think been $25 billion of new retail investment monies come into the market since the
lockdown. So like right through here. So what do you have to say to those new traders that have recently entered in the market? They're experiencing something, they're like, this is whoa, you know. What do you have to say to them, and how they can hang in there and really, you know, learn from this situation we've been in?
Well, I love looking at Helene's hand-drawn charts on the wall behind her, because I started out, Helene, as a point and figure chartist with a little graph paper making X's and O's. And by the end of the week, I would unravel it across my apartment in New York, and I'd start to see patterns. So I'd say, right now in these days, you do not have to. I love that you're doing it because there is something about that tactile sense that you get when you're actually moving the price with your own hand. And I think that's one of the reasons why you're such an incredible technician. And I still put myself on the floor and I can kind of feel the momentum along with the price charts from those back days. So I guess the lesson to the new traders is, definitely do not discount the power of technical analysis. It is, I actually just went to ChartCon conference, Stock Charts did, and I met Ralph Agcampora. Helene, do you know who he is?
Oh, wow.
Of course, right?
Yeah.
So, I mean, I got to sit and talk to him. He was the guy who basically put technical analysis as a legitimate way to trade and invest back in the 70s with the Wall Street Journal. So we had this great old talk. But anyway, so I would say whether it's whatever time frame, whatever indicators, at least learn simple moving averages, try to learn some basic chart patterns, number one. And then, you can start adding as you become a specialist in one thing. On the floor, all I had was point and figure charts. I wasn't tracking volume or momentum because I was there. So I think now that there is no there anymore, I'm looking at volume, I'm looking at momentum indicators. So that's from a technical standpoint, and that can make people's heads explode because people go, oh, I don't know how to read a chart. But, it's not as difficult if you take the time. And certainly people like Helene, and there are so many other people, Market Gauge, we're all there to teach you. There's YouTube information these days. It's so easy to learn.
It is, isn't it?
It really is.
It really is.
Of course, you can also get confused, but, if you find somebody that you trust and resonates with you, that's all it takes. The second thing is,
go ahead.
Do understand that there is, because of social media, everything has become so exaggerated, moves so fast, and this whole FOMO thing is a real phenomenon. And so you have to kind of step back and understand that once you really know where you are in price, you have to understand risk. Risk management is the other number two most important thing. Because if you don't really understand that I'm only willing to lose this much because I think I can make this much, and follow that discipline of that risk management or position sizing. And Van Tharp, who died actually last year, is the king of that. If you wanted to do some reading, that's the other second thing that you really have to you think for yourself. I mean, Helene learned to think for herself. I learned to think for myself. I was one of the few females, as you mentioned, and I had to think for myself because I could not go into the pit when there were 100 guys in there all jockeying and screaming and trading. And I was like this little person getting shook up. I had to step out and learn how to think for myself. So I guess that's really what I'm saying is through technical analysis, through risk management. Those are two ways to start. And of course, then I'd like to hear what Helene has to say to add to that.
Yeah, Helene. Yeah, what do you say to all those traders that have just entered the marketplace over the last few years? And I'm sure they're hurt. They may be feeling not so secure, or they're feeling insecure about their trading. And we've all been there, right? So what do you have to say to them?
All been there. Well, my first thing would be forget FOMO. You're not missing anything. One of the things I feel like I always have to explain to people is if you're feeling uncomfortable and you don't know what to do, sell the darn stock. You can always get back in. It's not like, oh my God, once I sold XYZ, I can't get back in if I'm wrong. I mean, that to me is just not the way you should think. Think about it. You're not married to it, okay? So if you did a bad trade, get out, and everybody does bad trades. So, I think one of the things that we find from social media and from television is that all of a sudden everybody seems like a genius. Everyone is not a genius. and that's really the first thing you should learn is everybody has losses. Okay, yes. Because when you meet the person who doesn't have a loss, you'll know they're a liar. So there's nothing wrong with taking a loss. And also know that you can get back in if you're wrong. And I think that that's really a very difficult concept because, oh, I sold it at 23 and now it's at 25. I can't get back in. Yes, you can if it's going to 30.
Right.
You know, forget that you used to own it. And I have to tell you, I have that problem too. I have this thing where, oh, that stock owes me. No, it doesn't owe you anything. Okay. Nobody owes you anything. You know, and I can tell you the other thing is that in my 40 years of doing this, I think I have top ticked in selling a stock. I think I have top ticked probably less than 5 times. So you're not going to top tick the stock. You're probably always going to sell it too early or too late. Leave it be. That's life. Now, in a bear market, selling too soon is never a bad thing. Really, I mean, you know, even this professional I know was moaning he had turned bearish in late July after having caught the June low. And he was moaning that the market kept going up. I'm like, you made money. Stop. It's okay. Now, if you get short too early, that's not great. But that would be my advice is, you know, take profits when you can, not when you have to. And you can always get back in, forget that FOMO stuff. So now in terms of looking at a chart, I happen to look at a lot of indicators. And so I also have this expression I like to use that bad charts turn good and good charts turn bad. And so just looking at the price doesn't always help. And so, for example, I started turning much more positive on the market in late September. And that was because not only were we extremely oversold, we have, if you take a look back in late September, we had an extreme number of stocks making new lows, which was actually still fewer than we had making new lows last June. But as these 3 weeks have gone on, we have not exceeded the number of stocks making new lows back in late September.
Wow.
So that is to transfer that into something that sounds more logical. Go back to Mish when she says, transport stopped making new lows and the IWM stopped making new lows. And I noted the industrial stopped making new lows. Okay, that's what that statistic is showing you. And so when you start to see that the number of new lows now is 578, but it was 1,100 3 weeks ago, and yet the S&P is down where it was, you have to say to yourself, I need to start looking at what's not breaking because something is holding. And the same thing when you get up near the highs. In early August, we were getting on NASDAQ 80 stocks making new highs. But you know what? A week before that, we were getting 100 making new highs. So something wasn't adding up on that last run up. Again, so start looking at your charts. What's not making a new high here? What should I be selling? So that's how
that makes a ton of sense. Now we Stelios Contagoulis just joined us. Hey, Stel, how are you?
I'm very well, thank you. Hello, ladies. I'm a big fan of both of your work. I have a question, if I may. So I was asked this yesterday. I was at the birthday party and I was asked this yesterday by a few friends. And I'll tell you what I said, and I would love to hear your opinion. So they were asking about markets, which way I think they're going. And I said, look, there is a risk which we haven't seen the effects yet of. I said that this risk is the housing market. Mortgages going up a lot. We haven't seen a proper correction lower in housing, and we all know what the wealth effect is like. You own a house, you see the price theoretically being higher, you're happy. Now we're seeing a double whammy where inflation is bringing all costs higher, energy, everything. Housing is going to start, I think, turning lower. So I think this is the one major risk which we haven't seen seen yet. I think it could be, especially with rates keeping going higher and higher, I think this could be a pretty big move. So I want to ask you both, maybe starting with Mish, what risks do you see that we haven't seen yet affecting the markets in a negative way?
Quite as concerned about the housing as the media suggests. Now, do I think that we're having a correction after things got so extremely bloated post-COVID, the exodus out of the cities, the rising costs of the materials to build houses, the basically 0% interest rates where you can get a mortgage for 3%. Yeah, I mean, that definitely has changed. But if you look around the country, there's a few things. First of all, in 2008, it's not really a great comparison. In 2008, they were giving subprime loans to people who were basically making no money, stated income. They could say whatever they wanted. Two, they were giving negative amortization loans, which means basically they weren't really even paying anything, and it was supposed to be amortizing at the end of the loan. And then all of a sudden, when that went away and they had principal and interest payments, they couldn't afford it. We have not been in that situation for a decade now. People have got 30-year fixed mortgages, and most people who, or at least should have, refinanced over the last several years where they could at much cheaper rates than they were getting in 2008, 2009, 2010, et cetera. So the other thing too is that we still have areas of the country that have shortages of housing. I mean, looking even at New Mexico, where I live in Santa Fe and in Albuquerque, there's still a low inventory. So even though prices have come down to a degree, there are people that want to still make an exodus out of places like California, for example, because of many reasons they don't want to be in California. And so when you start looking around the country, if they don't have a lot of new construction, there is still not a huge supply of inventory everywhere. It's regional, number one. And number two is people who have mortgages at 2 to 4%, let's say. Why would they sell? They're not going to be able to buy another house unless they're cash buyers, because they're going to have to pay double, if not triple, the mortgage rates that they're paying now, which also in essence creates a little bit more of a scarcity. So I think this mania of the housing bubble is coming is a little bit of muscle memory from 2008. But if you stop and think a little bit more logically, this is just like the natural correction that we see after rates were so low to higher, and even paying 6 or 7 or even 8% at some point when it becomes more the way, because it happens so fast and we sort of kind of maybe stay in that area, people will start to get used to it again. And then we have a whole generational thing, but we won't get into that now. The younger generations that really can't afford, yeah, that's a thing there. But still, I'm not panicked in that area. That to me is not where I'm nervous, is about what happens to the housing market.
Oh,
Okay.
then I want to hear what you're nervous about, but let's go to Helene first. So, Helene, what are your thoughts about housing like Stelios had asked? I mean, I know you don't, again, it's not, you're like, can I chart it? And you can, but do you have any thoughts there on that?
Well, I would just say that it's very typical to want to fight the last war. And so because our last fair market was 2008 with the housing crisis, everybody's looking for another housing crisis. And also people who have been in the markets for more than 20 years, 25 years, will say, oh, it's a tech bubble, it's a housing crisis, because we are all products of the market we grew up in. Okay, I started in the markets in 1982. So what's my first really big, bad, scary thing? The crash of 87. And I would bet you most people who went to work in the market in the early 80s and lived through the crash of 87, I can remember for years thereafter, all everybody talked about was, there's going to be another crash, another crash. Well, there isn't another crash, because guess what? They kind of took care of it and they regulated it. Now we can only go down a certain amount. Okay. And then we come to the housing crisis. And as Mish said, what we have is they're not giving out these no doc loans anymore. So if we have some kind of a housing slowdown or tumble or recession or whatever you want to call it, I don't think it's going to look like 2008 because it didn't start like 2008. So now on the chart, as I noted, the ITB still hasn't taken out the spring lows, and that's with much higher interest rates and much worse housing news. The chart I'm watching on housing is Toll Brothers. If Blake wants to put that up.
Yeah, by the way, this is the ITB that Helene's mentioning. So let's bring up Toll
Put up
Brothers.
a 1-year chart on Toll Brothers. All right, you see that? Toll, this is the third visit down to these lows. I have this view, and I can't confirm it, it's just from feel, that spike lows like you got last spring, when they get revisited, like we did a month or so ago, they rarely break on that second trip down. It's the third trip down or the fourth trip down you have to start worrying about. So, think about it like resistance. You eat away at resistance. You keep eating away at it until you can break through. Well, support is no different. You keep pounding away at it and eventually you're going to break it. So I'm watching Toll Brothers because if Toll can't hold and Toll breaks here, that's probably a sign that the lower end ones are not far behind.
That's an interesting point of view. Now, and it's good when you're learning about support and resistance like this. I always use like the tennis ball on a table analogy, Helene, where you got like a tennis ball and you drop it and the bounces are just a lot less, until it eventually rolls off the edge, right? So, but that's not a bullish look by any stretch of the means.
It isn't, but Blake, I don't know I don't use any of these fancy indicators that you do.
Yeah.
Whatever that blue thing is at the bottom, this.
Oh, this is an RSI.
All right, whatever it is, I find it interesting that price has made a lower low, but that's made a higher low. So
yeah,
maybe it's not ready to break yet.
That's divergent relative strength that Helene's talking about.
Fancy stuff you don't get on hand-drawn charts.
Hey, we have some questions that have come in from some of our viewers, but I'm going to ask this first of all. The chances of us, well, it's great to organize, but the chances of us being able to get both Helene and Mish here at the same time was just by chance, and I'm so happy that they're here. Therefore, take advantage of it. If you have some questions for these two lovely ladies, please bring them in. If you're trying to provide your own analysis, don't worry, I'll skip right over that. Let's see. Michael asks, wonder what sectors the ladies think will do well in the near term to medium term and why. So let's start with Michele. What do you think, Mish?
Well, we're looking at some of the we're looking at some of the money where the government is spending, particularly where they're giving money to certain companies for the agenda, whatever that is. And even after midterm elections, it could continue, although there may be, if the House goes more red, then we may have a little bit more of a stalemate, gridlock, as they say. But for now, the government has been investing still in infrastructure for electric vehicles. The government has been investing in big data. The government has been investing in defense. That's why you're looking at stocks like Lockheed Martin, et cetera, that are still doing really, really well. So I'm trying to kind of follow where it's not going to be necessarily scary on the balance sheet or so interest rate sensitive, because it actually kind of fits not only with my macro theme, but it's also that they're getting money from the government. Interested in huge amount of support, as did
Working on the new high list, TUR.
TUR, right? And then, and I'm, since we're approaching Thanksgiving, I'm like, well, you need a little grease with that turkey. So, KREK. And then also Mexico and Latin America did really well last week. They broke out of, so, you got to kind of look around. And of course, I wouldn't be me if I didn't talk about commodities. So I still think that even though we saw a huge drop in wood and in copper, in particular, I'll just say those two. If you look at corn and wheat and soybeans and sugar, they've come down, but they've been just sitting there like a wall of support. So any catalyst to that could make the food commodities go up. And I am watching this dollar, as I said in the very beginning. I am long gold. I am long Canadian miners, silver. I think that gold might have made a double bottom. I'd love to know your thoughts on that, Helene, looking at the chart.
Looked and I'm wondering, yes.
Yeah, right.
I'm wondering. Yes.
All right. And I can, let's stop there because I know a lot of people are really, really, invested in a gold, B, interested in gold. So
look at your blue line again. There's a higher low.
Yeah,
right.
yeah.
And look at that. I mean, if you want to talk about risk and knowing where you're wrong, I mean, it breaks that. You're wrong. End of story.
There's a great risk reward.
Absolutely.
And I'll tell you another thing to take a look at. Look at the chart at FCX.
Yep.
Which is copper.
Copper, right.
Just because you mentioned the copper.
It's coming back.
It's coming back, and it's over that early September high. You don't have a lot of stocks that have gotten over that early September high.
Yeah.
There's a Freeport McMoran matched up with copper with the front month copper.
And let's not forget about oil and energy, right, Helene? I mean, look at some of those charts. No, you're not interested in that?
They're fine, but it's so well known. Barron's had it on the cover. I've got, a lot of my charts there are up against the old June highs. I'm not going to get excited over oil here.
Well, look
I
at
don't
tech.
hate it like I hated it in June.
Okay,
I'm not
TECK.
excited.
What do you think of TECK, coal? Because I was looking at that today.
I don't
think
know that chart. If Blake throws it up, I'll take a look. Looks like FCX.
that's coal. Yeah.
Looks like FCX. What else did I write down here? SCCO. That's
now we're getting into this is the point where everybody's looking at the charts and they're saying the exact same thing. Ooh, yeah. All right. So what do you got? SCCO.
And I'll give you one more. CMI.
Cummings.
Because it's so different than all the others. Look at that.
Look at that breakout.
Yeah.
What the heck is that stock doing up there? I don't know.
I don't know, but somebody's buying it. Somebody knows something about something, right?
Somebody's buying it, and I'll give you one more. Take a look at PCAR.
Oh, yeah, that's a good one.
I used to trade that one.
Now, my problem with PCAR is that Barron's had it this weekend, and Barron's has it, and I hate it.
I love that you and we're so like-minded, Helene. I mean, once it's out there, I'm like, nope, never mind.
Right. Once everybody's talking about it, I'm like,
right, exactly. I like
nervous.
to be first in. Yeah. And then when it's all getting all hyped up, get out. By the way, industrial, Helene, have you looked at GE? General Electric to me looks very interesting.
Yeah, more so than GE. A couple of weeks ago, I started looking at 3M. That piece of crap stopped going down. I mean, what a piece of garbage that
boy, it is.
But look at that little, I mean, it's tiny, it's little, but it stopped going down. And I don't know why.
Well, go back to the GE chart too, because there's a nice double bottom there. That's what I was looking at.
Yeah.
Look at that beautiful bottom.
Right. But, I see whatever that red moving average line is that he's got up there, which is right near the old highs. I look at that and I'm like, oh, I don't know if he can get over that.
Yeah, but you know what? That
200-day.
supports exactly what you were saying in the beginning, though, is if you can get in with a relatively low risk and you get a decent rally into resistance, get the hell out.
All right, I'm gonna give you one more here. And
Please do.
This is really gonna be egg on my face soon. Because
that's a lot of let's hear it.
Because they report late this week. But I think Google looks okay here.
Oh, Nancy Pelosi bought some. Are you advising her?
Google.
I think
Probably the other way around. Nancy
make it a
Pelosi
little
is
bit of a
advising her.
a little bit of a shorter term chart, Blake.
All right. So here's a 4 hour.
There you go. Well, I don't need 4 hours, but 6 months. There you go. You see?
Okay.
It's just an interesting chart because you got kind of a double bottom there from late September. And then you had a higher low again this week. And it wouldn't take much to get it up over, Anyway, I just think it's kind of interesting, and it didn't die on the news last week about Snapchat and Meta,
And they're being sued by Texas.
I would assume a daily close above 103 would probably do the trick there. Previous support.
Now I will say they've got earnings at the end of the week, so risk reward is not good because that's
yeah.
A coin.
And it also, and Helene and Blake, it goes back to what we were saying in the very beginning, is if we're going to get any kind of into the midterm seasonal rally, certainly the tech is going to go up. Do I think longer term, though, I'd want to have my money still in tech? No, because our new interest rate environment is here to stay. And inflation is, you asked me what my biggest fear was. It's still, as what I've been saying, is looking for inflation in all the wrong places.
Right.
I still think that is probably my biggest fear, which is definitely not going to be great for the big tech stocks.
No, but we're trading.
Yeah, trading. Exactly. I just, I always like to give a little backdrop because I don't want people to walk away and go, oh, they're so bullish Google. And then,
No. Oh my God. Do you want me to tell you tops?
Oh, hey, there are a couple questions that have come in, and I think that are relevant. If you ladies have an extra couple of minutes.
Go ahead.
Okay, cool. What? You both are royalty to me. I love it. All right. So question came in. This came in from Carol's. Michael Burry has expressed his new prediction about the mother of all crashes coming, but he's still bullish on Facebook, Meta, Google, and Walmart. Do you also see FANG stocks being the safer haven for longer term? And Mish, we can start with you with that one.
Well, Michael Burry, you certainly have to raise an eyebrow when he speaks because he's had a relatively good track record. I mean, he called obviously for ARK to go down. He was right. He talked about Tesla going down. He was right. Clearly, the big short was his claim to fame back in 2008, although he sat through some pain. But, you don't want to necessarily take somebody as the gospel. So here's my thought is that at some point, and I'm not necessarily thinking now is the right time, there's just certainly, obviously, AI is here to stay, but that doesn't necessarily mean that every megatrend goes straight up. And I think, Walmart, he's talking about a consumer staple. It's been talk about a trading range. That thing has also been stuck in a trading range as well. So it hasn't exactly blown me out of the water. Google, we just talked about. I think that this big crash that he's talking about, I'm not quite sure he thinks that any one thing could survive, including commodities. We know when things go down, everything goes down.
Well, certainly Google is not surviving a crash.
No way. And maybe not even Walmart. And what was the third one he mentioned?
The third one would be Meta. Facebook.
Oh, well, listen, longer term, do I think that the metaverse as a marketing tool is going to be another one of those disruptive technologies that come out and people will stay at home and they'll create their avatar and they'll shop through the metaverse? Yeah, we're not there yet. I don't know how far his time frame is. I still believe in Zuckerberg. I think he's a genius. He just obviously, everybody is cyclical, including him. I don't think that anything that Burry said on this last statement impresses me at all. And it's
Helene, what are your
actionable.
thoughts there?
I'll go with what she says on Burry because I don't know him and I don't really know his work.
You haven't seen The Big Short?
Well, yeah, that's what I mean.
I'm just kidding.
I know what sort of the whole world knows. I have no special insight there.
I'm just kidding. Okay, well,
you know what I think of Google, and I do think Google has a lot of resistance overhead. So again, just to trade.
Got it.
Meta, I think, is kind of interesting because I've been pretty bearish on Meta, and I just looked on my what you can't see on my charts is when I get a breakout or a breakdown, I do a measured target and I just do it in pencil right on the chart. And I had forgotten that I had a 126 target on Meta. And I noticed it this weekend when I posted the chart. And I say that because the low of the last 2 weeks was that 126 area. So, you know, if you wanted to speculate that maybe the earnings aren't so terrible at the end of the week, fine. To me, that's again, not a great risk reward, you know, because it could gap down just as much as it could gap up. Only because I'm not big on playing earnings. However, this is probably the area that if you wanted to get long it for a trade, you'd look to get long it.
Again,
All right. Well,
risk reward
that's a good idea. Now I'm going to stop. I'm going to, since we're running fairly short on time, I got a couple last questions, but this one came to Mish. What's the best source to learn point and figures charts? It's a good
well,
question.
actually,
I have a
both
book.
platforms, right?
Helene's got the book.
Go
Have a
find some
book.
graph paper, right? But no, seriously, you can do it actually through technology now. Stock Charts actually has a point and figure chart. I know you spoke with Dave Keller earlier.
Yeah, he was awesome.
A big fan of his, and I do a lot of work for Stock Charts. I think most trading platforms will have a point and figure chart option, and then you can set the time frame. When I was doing it, when I was trading sugar and then crude oil on the floor, I was doing it 2 cents up, 2 cents down, X's and O's. But otherwise, just play. Go get some, just like what Helene just showed you. Go get some graph paper and a pencil.
Somebody has asked what the book is. So let me just tell you, it may not even be in existence anymore, but it's called The Complete Guide to Point and Figure Charting by Carroll, Carroll Abbey, A-B-Y Jr.
Okay.
Well, there you go. There you go, Casey. And that'll, remember, you're getting a recording of this, so don't worry if you didn't quite catch it. We'll make sure you get the recording. There's a couple of other questions that have come in, and I want to ask this of you just in general. Is there any big levels that you're looking at in the dollar index or any major index that's really like obviously you're looking at the lows in the S&P saying that's got to hold, we got a double bottom there, that's got to hold, or but is there anything that you're like, look, I'm going to drop everything and start jumping in the markets, whether it's short or long, because of these levels? Let's start with you, Mish. You have anything?
Well, let's go back to our granddaddy, Russell 2000.
Pull that up right now.
Yeah, 162.50. Actually, if you want, I can show you my chart.
Yeah, absolutely. Let's
because
do that.
I have a four time frame screen up here.
Please
so
bring it up.
Let me show you that.
While she's getting that, let me just say that yesterday I posted a chart of the Dixie on Twitter, and it's sitting right on a trend line. If it breaks that, it should be bullish stocks. If it holds, it's the same as if bonds don't rally here.
I missed what you said, Helene, because I was pulling up my
sorry. Yesterday on Twitter, I posted a chart of the Dixie. And it's sitting right on a pretty solid trend line, uptrend line.
Okay.
And we'll bring that up here in a moment. We'll definitely. Now, Mish, I just see the blue circle.
If it holds, I would say stocks are sort of in the same place as if bonds don't rally. If it breaks, it's bullish for stocks.
There we go, Mish. I see your
yeah, I didn't realize because I have two screens here, so I wasn't sure which screen you were seeing. All right, let's make this a little bit bigger so everybody can see it. All right, if I'm just going to bring up this chart right here, this is the monthly chart. So this is exactly what I was talking about, right? So here is your crash in 2008. It broke down under that 80 monthly moving average, came back, broke down ever so slightly when we had the almost default of the government back in 2011. And other than the pandemic, we have been on it or above it, well above it. So now if we go exactly to this month, look where it stopped, right there. So that's why I love this 162.50. To me, this is really key. If this thing breaks down, then transportation, retail, and the whole market will definitely break down. And then maybe we can start talking more about where we were as we were coming out of the pandemic at around 115. That's a huge, there's your 20% drop that people like Ray Dalio and Burry and what's his face, Jamie Dimon, and even Bezos are talking about. But we're not there yet. So I wouldn't worry unless it actually broke that. If we take a look at this on a weekly time frame, this is also a really interesting chart because, sorry, I'm just trying to get this out of the way here. Hold on, come on.
Also, if you draw in and you connect the top from prior to, I think it was 2018, the 2018 drop, and prior to the 2020 drop, that's pretty much where the IWM stopped as well.
Exactly. Now look at this one. This is the weekly chart, Helene. So you see it went right to the 50-week. It's broken down under the 200-week. There's your double bottom. So here's the other point I'm looking at is if it can get back over the 200-week, this goes from looking like a potential head and shoulders top if this breaks to now maybe really confirms more that double bottom. So the other really key indicator right now would say 178, 179 on the weekly chart. So you see how, once you start putting together all these different time frames, it looks interesting, right? If we take a look at the daily chart.
It lagged on Friday big time though.
Yeah, so here you go. And this is my momentum chart. This is our real motion indicator. And this is showing that it broke out over the 200 on momentum, but it still hasn't cleared the momentum that it made here when it made this high. So essentially what we're really talking about now is we got to break out on that weekly chart. We got to break out of momentum. And if we start to drop from these levels, then, so you were pivotal. We're super pivotal right here, as far as I can see. We have a lot of cash and we're waiting to see which way these things go. And of course, watch the dollar. That's my other.
Yeah, that's huge. Helene, do you want me to show the dollar index? Is that
you can? Or people can just go to my Twitter feed. I posted it yesterday. It was pretty cool.
I was gonna say that it's at least the people that are here, it's really good to get a visual of what you're thinking. So let me just pull up the dollar index really quick. I'll just pull up one that I can actually delete everything. This is just a daily chart. So what were you looking at here?
Well, let me get my ruler and show you.
Oh yeah, bring in the ruler.
Ruler.
All right. Essentially, if you connect, it looks like the July low, the early September low, the mid-September low. You're sitting right on that uptrend line. I mean, on my chart, you are. You're using candles, so they're different. Yours looks maybe like it's arithmetic.
Yeah,
for last low.
Here, connect this low. Can you see my arrow?
Blake, the four last lows begin from the one posted in August.
Begin from the early August low.
Later. That one.
There you go.
That one.
There you go. You got it.
Got it. Okay. My eyes are automatically drifted over here. Okay. Got it.
I like this line because I'm a simpleton. 2 points make a line, third confirms it, more points on the line, the better the line. You got 4 touches now.
That's that means if it breaks, it could really break.
If it breaks, it means you've changed the trend that's been in place since August. And let's remember, what has the stock market done since August? Go down.
Yeah. And
so it's all the same trade.
It is. It's all interconnected, and you've made so many points with the other markets that both of you ladies are looking at, which I think is huge. I want to say, first of all, say hello to both of your husbands for me if they're watching. Keith, hi. Ken, hi. All right, I had to do that. Both of your husbands that happen to both be in the markets too. But I wanted to say it has been really wonderful here at the Trader Summit to have both of you ladies bless us with your knowledge and your time on a Sunday. You may or may not be looking forward to watching football a little bit later.
Giants, go Giants.
See,
Tennis,
here we go.
tennis.
And that's but I
And
want to
Kansas
say
City.
thank you so much for spending your time with us. What's the best way for us to follow both of your work? So let's start with you, Helene. Best way for us to follow your work.
Well, I write a daily column for Real Money. So come on over and have a look. And if you want, you can follow me on Twitter. I'm at H Meisler, Meisler. And there you have it.
And always one of the best. You get so much engagement on your tweets. It is absolutely stunning, and it's awesome. It's because you put out some of the best charts out there. Mish, we love your work. We love your work on the daily here at the Traders Summit community. But if people want to find out more about you, how do they do that?
Well, we have a YouTube channel because I am on the media a lot.
Yes.
A lot. And so what we've done now is we take the clips of every appearance that I have and we put it on our own Market Gauge YouTube channel. So if you want to hear what I'm saying to everybody that I'm talking to, whether, this will probably be on our YouTube channel, everything that I do. So that's one way. That would be Market Gauge. If you go to Trader Summit every day, you see my daily, which is also published on our Market Gauge site. And I also do a lot on Twitter, and that's at Market Minute. So I'd say those are probably the main things. If you check out our Market Gauge site, we have a lot of free material other than what I put out. Keith, you mentioned, puts out a weekly market outlook with a big view, which really tracks all the internals and breaks it up into risk on, risk off, and neutral. So, we're educational. That's what we are, a financial education publishing company. So that's what we're here for, is to try to help educate you. So please feel free to reach out. And Helene, before we end, oh, what a pleasure. I feel like you and I, we've known each other, even though we haven't known each other. So it was really
Delightful.
Yeah, I may direct message you just to ask a couple of questions of where you're at and stuff like that.
Happy to.
Okay, great.
Great.
And Blake, thank you so much. And Stelio and the whole team and everybody.
Thank you, ladies.
Thank you very much. It's been a pleasure.
Thank you, ladies, for being with us. We really do appreciate it. And enjoy the rest of your Sunday.
Thanks very much.
Bye-bye.
Bye-bye.
Bye-bye.